This is the College Investor Audio Show. Thank you so much for being a part of things today. So, we asked the question and attempt to answer it the best we can. Could the federal government privatize student loans? But first, just a quick reminder, anytime you hear anything on the podcast, you can always see the article associated with it at thecollegeinvestor.com. Just type in the title of the podcast right into the search bar and you'll find it. You can also like us and follow us all over social media. We are at The College Investor, and you'll find us pretty much anywhere you are. All right, so let's do this. The Trump administration is once again weighing whether to sell off parts of the federal government's $1.6 trillion student loan portfolio to private investors, a move that could kind of reshape the nation's higher education finance system and affect more than 45 million borrowers. According to some reports, senior officials at the Education Department and Treasury Department have been exploring how to offload high-performing federal loans to the private market. The discussions, which have allegedly involved finance industry executives and potential buyers, reflect the administration's broader goal of shrinking the government's role in student lending and reviving private sector competition. This comes after reports earlier this year that Trump wanted the Small Business Administration to take over the student loan portfolio. The administration is looking at whether privatization could help reduce administrative costs and improve portfolio performance, actually. However, the move could end maybe some borrower protections, including income-driven repayment options, loan forgiveness programs, and the government's unique ability to offer flexible hardship relief. This isn't the first time the idea has surfaced. The DOE chapter in the Project 2025 document actually proposes reviving the old Federal Family Education Loan, FFEL program, to privatize all lending programs, including subsidized, unsubsidized, and PLUS loans, both grad and parent. Okay, so what exactly would it mean if federal student loans were sold to private lenders, and could it really happen this time? Let's unpack the latest proposals, political motivations, and potential consequences for borrowers. Shall we? We shall. History of the FFEL program, which is what I was a part of, and it worked. Private-federal partnership. All right, so before its discontinuation on June 30th, 2010, the FFEL program enabled private lenders like banks, credit unions, and other financial institutions to make federal student loans guaranteed by the federal government, which is no different than a VA loan or an FHA loan for a house. It's pretty much the same thing, just guaranteed by the government. These guarantees covered defaults, with guarantee agencies stepping in to purchase defaulted loans on behalf of the U.S. Department of Education. Additionally, lenders received special allowance payments to ensure a market rate of return. At its peak, the FFEL program dispersed $63.8 billion in new federal loans during the 2008-2009 academic year. 1 year after I graduated, by 2010, outstanding FFEL loans totaled $516 billion, spread across 25.1 million borrowers. Since the program's discontinuation, the portfolio has steadily declined as borrowers repay, discharge, or default on loans. Today, $165 billion in FFEL loans to 7.3 million borrowers remain outstanding, of which $65 billion to 2.4 million borrowers is still held by commercial lenders. That's interesting. In comparison, the rest of the federal student loan portfolio now consists of $1.47 trillion in direct loans owed to 38.2 million borrowers, alongside nearly $100 billion in FFEL loans owned or managed by the the government. The Healthcare and Education Reconciliation Act of 2010 shifted all new federal education loans to the William D. Ford Federal Direct Loan Program starting July 1st, 2010. Federal student loans are operated at a loss. No way! It's important to note that the U.S. government loses money on student loans. Currently, only Parent Plus loans generate a net profit for the federal government, based on program costs as calculated under the Federal Credit Reform Act of 1990. Even these loans operate at a loss when assessed under fair value accounting standards. As a whole, though, the federal student loan portfolio loses a whole bunch of money. Several factors contribute to these losses. Below market interest rates, loans are made without regard to a borrower's future ability to repay the debt. Subsidies embedded in income-driven repayment plans, which can reduce loan obligations by as much as 63%. Financial impacts of the pandemic-era payment pause and interest waiver. Yeah, that was a big deal. Claims that privatization would save money primarily stem from eliminating federal student loan forgiveness and discharge programs and from eliminating outlays from specific loan programs, not from operational or efficiencies. A key aspect of the privatization proposal is the only way the president could potentially move the portfolio without Congress is if the move doesn't cost taxpayers money. It's unlikely that banks and private lenders would buy these things without guarantees and, money. Here are the benefits, though, of privatization. Privatizing federal student loans could offer a bunch of really cool stuff, like reduced government involvement, which for somebody like me is like, please. So privatization would shift some financial risks to private lenders, which would reduce the national debt and streamline government bureaucracy. Or eliminate it? Can we eliminate bureaucracy? Anyway, enhanced efficiency. Private lenders might, probably, process, service, and collect loans more efficiently than the federal government. And also, respond to your messages. Oh, and you can, call them. Market-driven accountability. By evaluating borrowers' creditworthiness and ability to repay the debt, private lenders could encourage more responsible borrowing. Improved loan options. Privatization might foster competition among lenders, potentially resulting in better customer service, answering the phone, innovative loan products, and diverse repayment plans. Financial literacy, too, because private lenders could actually require enhanced loan counseling to promote informed borrowing decisions, which is just like we do with mortgages. Here are the disadvantages now of privatization. That's kind of not without its downsides. So one thing would be it reduces your access for higher-risk borrowers. Private lenders might restrict access for borrowers with poor credit or those attending less selective institutions, potentially requiring creditworthy cosigners or charging higher interest rates and fees, which is what we do with everything else. Fewer repayment options. Many private lenders do not offer flexible repayment plans like income-driven repayment and graduated repayment, although with competition, you could argue that they probably would consider doing those things. They may also offer fewer deferment and forbearance options. Competition could and might kind of quell that fear. Elimination of loan forgiveness programs. Borrowers would likely lose access to forgiveness and discharge benefits. It's a big deal. They will be expected to repay their student loans in full. Higher costs for the federal government. Selling federal loans to private entities would require financial incentives, like guarantees or subsidies, like we do with Fannie Mae and Freddie Mac and that type of stuff, secondary mortgage market, all that, to make the loans more attractive to private lenders. There are administrative challenges, too. Transitioning to privatization would be logistically complex, akin to the disruptions caused by the pandemic-era payment pause. And then, decentralized borrowing. Now, for a lot of people, the word decentralized is like good news, but anyway, to others it's not. Borrowers would lose access to a unified system, like the next-gen student loan servicing platform, making loan management more fragmented. Or on the flip side, if you kind of oversaw the privatization of the student loans and encouraged more competition, some of these fears could kind of go away. Here are some practical considerations. Congress is unlikely to approve legislation to privatize student loans. As such, a move would not reduce the federal budget deficit. Furthermore, backlash from borrowers and advocacy groups concerned about college access, affordability, and borrower protections could hinder privatization efforts. There are arguments on both sides. Privatization is good, privatization is bad, federal student loans are good, federal student loans are bad. There's arguments on all of it. The process itself would be administratively burdensome, although maybe worth it, and could mirror the complexities seen during the restart of federal loan repayment after the pandemic. However, with some time, it would get better. Just offering different perspectives is all. So how could privatizing the existing student loan program, how could this all work? Okay, privatizing student loans could involve selling the existing direct loan and federally held FFEL portfolios to private lenders, while reinstating the FFEL program for new loans. However, this approach would not amount to full privatization, as loans would still operate under their existing federal terms and conditions, or the loan agreement, if you will. Most private lenders kind of lack the appetite to take on federal loans, go figure, even with guarantees and subsidies. When it comes to guarantees and subsidies, the government would have to be heavily involved, still, covering losses for lenders for defaults, providing incentives for existing loan forgiveness programs that are mandated by Congress, and more. Kind of like what the FHA does. Maybe privatizing student loans could just kind of mirror what FHA does for mortgages. I don't know, I'm just saying. Private lenders may also lack both the financial capacity and administrative capacity to acquire the loan portfolio. The FFEO portfolio, which was never more than a third the size of the current direct loan portfolio, was funded through a combination of incremental bond issues and securitizations through the capital markets. If the private lender were to acquire the direct loan portfolio or parts of it, it's likely they would contract with the existing loan servicers to provide borrower administration, as lenders themselves wouldn't be able to ramp up a servicing organization to handle the loan portfolio. As such, borrowers would still likely work with companies like Mohila and Aidvantage for their student loans. Let's take a look at some alternatives to privatization. If this proves kind of impractical, other approaches could be considered. Get rid of all government bureaucracy, put more money in everybody's pocket so they can pay for their own school. But if that doesn't work, discounted loan sales. Selling loans at a discount without default guarantees could reduce federal involvement. However, it might not be legal without Congress. The second thing, selective forgiveness. Forgiving uncollectible loans while selling the remaining portfolio might increase its attractiveness to private buyers. Lower loan limits. Setting aggregate loan limits based on post-graduation median income could actually encourage borrowers to choose less costly institutions. Go figure. Annual limits would be derived from the aggregate limits. Federal loan limits would no longer be based on how much the college chooses to charge. Private lenders could provide supplemental financing to lower-risk borrowers based on the borrower's creditworthiness and future ability to repay the debt. This means that higher-risk borrowers might be prevented from enrolling at higher-cost colleges, since they would be unable to obtain loans to pay the cost. Instead, they might have to enroll at in-state public schools or community colleges to get some prereqs out of the way, and colleges, of course, with no loans financial aid policies, which tend to be less expensive. Which, again, is what we do for literally everything else in our life. Shop, research, look around, do some homework. Here are some final thoughts. While privatization may offer some benefits, its disadvantages, and the logistics of the whole thing, make it kind of unlikely and potentially costly. Instead, targeted reforms to improve efficiency, reduce risks, reduce the size of government, and balance access with sustainability might be more practical alternatives for the near future and for addressing the federal student loan system's shortcomings, which there are a lot of shortcomings. I hope this was helpful, and at least it gave you both sides of the coin, too, because there are some other ways to look at this, like having better education and literacy about money and borrowing and loans and all that stuff, and interest rates. If we just understood it all before we started shopping around for colleges, I think we'd all be in better shape. That's maybe a topic for another day, and of course we have tons of topics like that at thecollegeinvestor.com. You can dive deeper into this one and so many more. So much more going on at that website. You can also follow us and like us with questions, comments, anything like that. We'd love to get to know you and help you along in your money journey and your loan journey and everything. Just look for us at The College Investor, and you'll pretty much find us wherever you are. Thanks again for stopping by today. We'll talk to you again real soon.